am here to talk to you today about year-end tax planning, specifically as it pertains to capital gains and losses and qualified dividends. Primarily, let's talk about capital gains and losses. And they fall into two broad categories: short-term transactions and long-term transactions. What we really want ultimately for the best possible tax result are net long-term capital gains. We're in November 2019. It's been a pretty good year for investment portfolios. So most of us right now are probably looking at net realized gains in our portfolios. So from a tax planning perspective, if you have net short-term gains, those are taxed at whatever your marginal tax rate is. The benefit of having net long-term gains is there's a special tax rate that applies to net long-term gains, and you can save 15 to 20% on the tax rate by having net long-term gains as opposed to short-term gains. So typical year-end tax planning is you look at your portfolio to see, are there any losses I can take, particularly to net out to zero my net short-term gains. So we're not paying any tax at our highest tax rate on those net short-term gains. If we end up with net long-term gains, that's not necessarily a terrible thing, but if you have losses in the portfolio that you can take before the end of the year to reduce the net long-term gains, that's a great thing as well. Maybe you have something you're holding in your portfolio, a stock you're holding in your portfolio that is at a net loss, and you really still want to hold that stock, so you're hesitant to sell it to offset against your other gains. You can go ahead and buy it back in 31 days, so you can sell it, take the loss, and 31 days from now you can buy it back, and that loss is allowed. If you were to buy it back in less than that time, it's called a wash sale, and they actually disallow the loss. So try to avoid that. One thing you can think about is, okay, I don't want to be out of the market for that money for 31 days. You can sell the stock and perhaps take those proceeds and put it in a similar company for those 31 days, or maybe buy an exchange-traded fund that's in the similar industry to the stock you sold, so at least you're still invested in that area of the market for that money. So that's just kind of a quick year-end primer on capital gains and losses. Tax rates, we didn't talk specifically about tax rates for capital gains and losses. We just talked about ordinary versus long-term. So depending on what tax bracket you're in, you could actually be in a 0% tax bracket for your net long-term gains. That can be a big benefit. So make sure you're talking to your financial advisor, your tax advisor, to try to take advantage of qualified treatment for those net long-term gains. On your dividends, not a lot of planning related to dividends. The important thing to be aware of there is that qualified dividends are eligible for special tax treatment. And a qualified dividend is a dividend that's paid on a mutual fund or a stock, an equity mutual fund or a stock, as opposed to an ordinary dividend, which is paid maybe on a bond fund that you have in your portfolio. That doesn't get special qualified tax treatment. Okay, that's in a nutshell year-end discussion of capital gains, losses, and dividend income.